Hello and welcome to Options Guy TV. My name is Brian Overby. I am the author of the Options Playbook, and I will be your host for about the next 25 minutes or so. The markets are tumbling, and it's October. What can you say? Geopolitical concerns are an issue. Rising bond rates, the 10-year going all the way up and touching 5% and then backing off a little bit. Right now, we see the yield on the 10-year at 4.931. A lot of people are saying that the bond market is doing the job of the Fed. So we've seen the probability of the Fed raising interest rates on November 1st, their next meeting, go all the way down, drop precipitously down to about a 5% chance of them doing that. So they're still not taking it off the table. They're always saying data dependent that the rate hikes may, after November, go into the next Fed meeting. There's still a probability that they still might raise the rates. But the way things are going right now with everything across the globe, it's leaning towards not doing any more damage to the economy. And I do think at this point in time, I kind of wish they would just pronounce that they're done. That would be a little bit of a bounce in the marketplace. We're going all the way out to March. If I look at the CME Fed Fund futures in March, there's actually a small probability that they might start cutting rates. And, I guess that would be the one driver of the marketplace that would make you want to get bullish. Obviously want to get bullish going into that. We've done a boatload of iron condors here on Options Guy TV. Every Monday we've gone out and we started with doing a longer term iron condor, which is a more, I think, like a monthly trade that I would do if I'm looking at iron condors and I'm trading those iron condors monthly. Then we looked at a little bit shorter term. And then this week we did a very short term one just to try to, change things up a little bit. It's not short term iron condors or short term spreads are tough to trade and tough to manage. And so for the first time on any of the iron condor paper trades, and as always, we always like to say that they're paper trades on Options Guy TV. And for the first time, we've actually had the market come down and go below our short put strike or even above our short call strike. So there is a potential adjustment. Now, here's the downside of doing short-term options. That adjustment you have to make right away. And unfortunately, we don't on Options Guy TV say, well, we're going to do an episode as soon as the underlying ETF hits our short strike. But that's when I would want to do it. Right now, I see the SPY is down 355. We see the VIX has skyrocketed up above the 20% level. I think that's the new level as far as high volatility is concerned. It took forever for us to break down below the 20% level in the VIX. And now we've finally broken up above that level. And with all of that going on in the marketplace, we've had a couple of real rough days in the market. And we're in October. We're going into a weekend. So it's a dangerous trade in my mind to go out and actually roll this position. But I'm going to. Why? Because that's what Options Guy TV is all about. Talking about the trades that win over and over again is those ones are simple, right? It's easy to trade out of a winning trade, but what do you do when the market goes against you? And this actually is part of the reason why, if I'm doing iron condors, I like to go out further in time, look at the first iron condor that we did 3 weeks ago, I think it was, on a Monday. We went out and looked at a 42-day option contract with the intention that we're probably out of it in 20 days. Not that we're going to spend the entire time all the way to that expiration date. But when you go longer term, especially on short spreads, you don't get the huge rate of decay. But when the market comes at you and the trade goes against you, it gives you an opportunity to roll because there's still some premium in it. There's still some premium in the options that you would roll. There's still some premium in general, just even protective wise. If you are short a call spread or short a put spread, which makes up an iron condor, if you combine both of those trades, if the market comes against you, you want time premium. You want that put option that you bought or that call option that you bought to protect your spread. You want that to have some premium in it, and it helps offset some of the losses when it's going your direction. Now, in the SPY, the fact that the VIXs came up has helped a little bit, but it's a Friday before the Monday expiration. So a little bit too late in the week to really be able to pull off this trade. And I think let's run to the TradeHawk software over here at Tradier. And I just drew one line in the sand that would make me, that makes me nervous. So if I was going to do this adjustment, I would probably wait till a little bit later in the day. I don't think I want to adjust it now. If anything, I would just trade out of it now. And that's probably what my approach would be if I fell asleep this morning and I missed the fact that the market was tumbling. Then I would probably just close out the trade because it's such a short-term trade. So with that caveat, if I highlight here on the SPX, this isn't the SPY, not that big of a deal, but the SPX, which obviously the SPY tracks, right around 4,200, you see there's a lot of noise in this range. So we have the 200-day moving average. We did have the crossover where the 50-day crossed over. The 20-day crossed over to the 50-day. We're still we didn't quite have that come back down to where it's crossing over the 200-day moving average, but they're definitely combining. They're coming together right in that range. And I'm going to zoom in a little bit on this one area right here. And you can see that right around here is a scary area. If we do break below this little support area and below the 200-day moving average, so I put it down at around 4,200. I think that is just those nice round numbers. A lot of people pay attention to them. There's no real rhyme or reason to it. But I would be nervous in this marketplace going into Monday if we broke below that level today. So let's go in and look at the trade, and let's look at a potential adjustment. It's not a very good adjustment because, once again, it's too late in the week and we didn't have enough time premium in our short put spread. But let's go and take a peek at it. All right. So here's the SPY. The trade that we put together was an iron condor. So obviously the call side of things is doing well. We even talked about closing it out for a dime on Wednesday's show on the call side of things. But on the put side of things, the 426 put is where our risk came in. So we've already blown through it. Ideally, if I'm going to roll this, I'm going to roll somewhere around that 426 level. We're now down around 423. And here is the initial trade, which would have been the October 23rd expiration. All right. And this is highlighting the strikes. So we sold the 426. Right now I'm showing a buy in there, but we sold the 426 and we bought the 421. Now that trade, I guess I'll just remove this. It's fine. That trade is trading for $2.53. Now, we put this entire iron condor on for 86-cent net credit to the account. So if you multiply that by 2, if I was looking to just get out of the trade, my maximum I could have made was 86 cents. I would have got out right around 170. 170 is where my pain point would have been to close out this put spread, especially because this is such a short-term trade. Or when we were down around that level, which we're probably somewhere close to that, to the actual short put strike, I might have rolled it. And here's the way the roll would work. I'm going to be very cognizant of the 4,200 level. I do think that is a short-term line in the sand just from peeking at the chart and everything that was going on there. And I want to go out as short as possible. I'm nervous. We're still in October. So I tried going like 5 days out, 6 days out. There's just not very much premium in it. Ideally you'd have to go all the way out to October 30th, which is about 10 days away. Makes me nervous to try to roll that, but I still can't get it done for a net credit to the account. So I'll click on that. Let's do the 30th. And I'm going to roll as tight as we can, which would be the 420. Means we're going 2 weekends. We're going to have 2 Mondays. Mondays are always a scary day in the marketplace, especially with what's going on geopolitically. And yeah, Mondays are scary. So I really don't want to put 2 weekends into this roll. So once again, there's a lot of caveats on this, but this is the way the roll would work. We were short the 426 put. If I go back over here and look at this trade, we were short this. So now that turns green because instead of selling it, we're buying it now to close it. And we were long the 421. That was our protection. So with that one, we were short it. Now we were long it. So now we're going to sell to close it. Okay, that's going to be the closing trade. We're going to lock in a net loss on that short put spread. We're going to roll out then to the October 30th expiration. And I told you the line in the sand is around 420. I wouldn't mind doing the 419. I'm going to keep it simple and just do the 420 because I don't necessarily think that I would want to do this trade anyways. But I want to show you how the roll would work. So on the 420 expiration, I would then sell that option contract and go down to the 415 and I would buy that one. So if we do this, that's got to change a little bit. We're selling this. Oh man, that's bringing in $1 on the trade. Has the market been moving against this? Yeah, it looks like the site's froze for a second there. There we go. Okay, so right now to close that position is $2.50. That makes sense. And if we go to the October 30th, we're going a little slow on the side. I apologize for this. It should brought in about another $1. So in other words, it should take some of that risk off the table. And the spread, we should be able to bring about $1 in to roll down to that level. Okay. October 30th. All right, I'll try one last time here and see if this works. Okay, so we're on the 420. We're going to sell this, and then we're going to buy the 415 ask. Okay, there we go. So now, if I'm going to roll and I feel comfortable with this trade, I would want to get this done for close to even. I can't do that right now. So we're going to reduce our risk. We were down about, well, when I looked at this trade to start with, we were down about 255. Now, if we do the roll and we go all the way out to October 30th, we can reduce our risk from 255, if we just closed it out, to a limit price of 112. So our net debit then will be 112 instead of 255, but the market's got to stay above that 4,200 level or 420 in the SPY. And this entire trade is what you would send to the trading floor. You're going to buy, and it says open on the screen, but I'll give you the right vernacular. We're going to buy to close the October 23rd 426 strike put. At the same time, we're going to sell to close that October 23rd 421 strike put and go out to the October 30th expiration and sell the 420, and then on that same expiration buy the 415. And we're going to enter this at a net debit to the account of $1.12. And on my 1x1 iron condor, that I had on, we would then now be short the 420, 415. On Wednesday, we ideally closed out the short call spread, and then we just would play the hope game here and hope that it does not go below that 420 level. And like I said, this trade would make me nervous. It's a little bit late in order to do this, and I'm actually going to let's run to the main screen here. I'm going to pull up options playbook, and I'm going to show you a section inside the options playbook that I think you will appreciate. So let me get that up right here. 1 second. And so this is the options playbook website. I'm going to zoom in on it a little bit. One more time. And there's a section called managing your positions. I don't go into a lot of detail into the book. As a matter of fact, if we do another book, I think I'll spend more time in this section. But rolling a short call spread. We also have rolling a covered call, rolling a cash secured put, but we're on the put side of things. But here we're looking at rolling a short call spread. And the biggest rule on rolling the big short call spread to me is that I want to do it when I get to that short strike. So if the underlying market, now in this example, imagine you're bearish on XYZ and it's trading at 53, you sell this. So if I'm selling this, if the market gets to my 55 strike, the market would come up in this example. That's when I want to consider doing the roll. I don't want it to go too far against me. Now, other things that are just kind of rules of mine on short call and short put spreads is if it does go against me, then if I'm going to get out of the trade, I don't want it to go all the way through my spread and beyond. To me, that's too far that it's gone against me. So what I would be doing in that case is I would be, if it ever reached my long strike, which in this case would be the 60 strike call option, but ever reached that, and I'm looking to close it out, I'm just going to close it out. Here's why. That call option would then be the at the money option contract. That's where all the premium hangs out. And if there's any premium left in that strategy, I want to take advantage of that. Once it goes beyond that 60 strike call, well, then it becomes more intrinsic value and less time value. There's a lot less benefit to selling that option contract. And that's the one thing we got to sell. That's the thing that's offsetting our risk of the 55 strike call. So I never want a short spread to go beyond the long strike in my position. And if I'm going to roll, I suggest reading this section inside the options playbook, rolling a short call spread. You just take the section and you apply it to all the lessons that are inside it. You apply it to your short put spread in our instance today. So we went there. We looked at, and so let me run back up here again, and we'll get back to the TradeHawk software. And we looked at doing a roll, and that would be the roll. This would be the roll that I'd want to do. I really didn't even like going out till October. Ideally, I probably would just close this trade out. The market went against me. I probably would have closed it out when I was down about double on the trade. The market made a strong move in the last 2 days. Things aren't looking too cheery right now. The fact we got a weekend coming with everything that's going on geopolitically, I would look to probably just get out of the trade. That's the way that I would approach this short put side of things. So we had 2 iron condors that did really well, and we've had now 1 iron condor, and it's the shorter term one, which this is not the way I really want to trade short spreads. As a matter of fact, down on the trading floor, a lot of people, let's just talk about short options in general. They call the last week to expiration gamma week. And the reason why that is as time premium dries up and an option contract gets in the money, the delta will explode. And gamma is what is the change of delta, right? So they call it gamma week because there's a ton of gamma that will drive delta higher when markets are going against you. So there were a lot of traders when I worked in the Chicago Board Option Exchange, which is now CBOE Global Markets, I guess. They changed the name of the exchange. But when I worked there, a lot of people would just not be short anything the last week to expiration. if they can manage it, right? You're a trader on the floor. You don't always get to choose exactly what you're doing, but that is the way that they would approach that trade. Is if you're short premium, you try to avoid being short premium in gamma week, it's trading for a nickel. You just buy it back and close it out, because if the market ever surprises you, it's very painful in the last week to be short any type of premium. Hence the reason we started the Iron Condor, I guess, lessons, because we've done a few of them, with a 42-day option contract. That was the first Iron Condor that we put on. And that's the reason why. Okay. So if you have any questions, please do put them in the chat box, and we will try to address them on the show. I do see Eric's got a comment more than anything. So let's put that comment up. Tough to close near expiration. Yeah, it is. We're in the SPY though. We can close it out. You're going to have liquid markets, especially on a day like today. It's really tough to roll this close to expiration is the way that I would phrase that, Eric. It's tough to roll this close to expiration. It's kind of like you drove the car off the cliff and then you took it to the repair shop and said, please fix it, right? There's just not that much that's left to be able to fix that car after you drive it off a cliff. And I think the only time you really get that scenario in short spreads and just option trading in general is as expiration approaches. I've had a lot of people come to me just with comments and questions and be like, what do I do? What do I do? You close it out and you move on, right? Did you stick to your strategy? See what you did wrong? Did you get out when you said you were going to get out? Review how your process in the trade, and then go on out and persevere and try to find another trading opportunity. So a lot of times the right answer is to just close it out. And I think that that's very, very much so the case here, because we're still within the strike prices, right? It still hasn't hit us that hard. So I'm going to go back to the original trade. See, these are the strikes, 421 and 426. So we're going back to that. That's where we're at. We're getting down to my second rule, 421. If the market's it's gone down quite a bit actually since we started the show. So if we get down to 421, I would get out. That would just be like if I fell asleep, I didn't get out when I was down basically double the credit that I received. This is the spot that I would sell it at. I do not want it to go beyond 421. I'm still getting $2.12 for that option contract. Makes it feasible to close it. Okay. So we do have a few minutes if you want to follow up with any other questions. Today, I wasn't planning on putting on a new paper trade. We have a lot of the magnificents that are going to be announcing earnings next week. So around those earnings, I always like to look at strategies. Not that I'm always saying that we should speculate on earnings, but it's a very interesting time to learn about option pricing. Amazon's going to be announcing on Thursday, and they always announce on a Thursday after the close, at least for many, many, many years. I guess it's not written in stone that they have to, but they're one company that chooses to announce on a Thursday. And then that means that the options contract's got 1 day to live. So you can buy that Friday expiration, and it makes for a very interesting trading scenario in a very expensive underlying that a lot of people own. So we'll look at that. And also, we've gone back. If you're a little nervous about the marketplace going into October, we did an Options Guide TV that talked about buying protection, looking at collaring your positions, either selling some calls against your positions or going out and selling a call to help buy a put, i.e. the collar. Obviously, you can look that up in optionsplaybook.com if you want to get a little bit more detail. And right now, I don't see any other questions. So I guess that's going to be it for this episode of Options Guide TV. Please click subscribe, ring the bell, pound that thumbs up, share with friends and family. Let them know about Options Guide TV. We want to make this a very interactive show. And considering what's going on in the marketplace today, I'll finish by saying, stay safe out there. See you.